This is Optimal Finance Daily, episode 1927. Can dividend stocks fight inflation while accelerating portfolio growth? By Stein of CashflowCookbook.com. And I'm your host and personal finance enthusiast, Diana Merriam. We're going to get right to it and continue optimizing your life. Can dividend stocks fight inflation while accelerating portfolio growth? By Stein of CashflowCookbook.com. Valuations are stretched. 5 great stocks to grab now. A crash is coming. Inflation will eat our returns. Buy and hold. Well, which is it? And how can we protect ourselves if things really do go to hell in a handbasket? What kind of investments are best right now? One idea is quality dividend stocks. Why? For the reason that dividend stocks fight inflation. In addition, the right ones can be had at a reasonable price, offer rising income, and be good bets for thriving in the ups and downs of the market. The case for dividend stocks. Well-managed companies are able to grow their earnings year after year. If they have more cash than they can profitably invest in the business, they sometimes return it as dividends to the shareholders. The most confident businesses increase those dividends each year. Those that have raised their dividends consistently for the last 25 years are called dividend aristocrats. Here are some benefits of dividend stocks. Number 1, the dividend aristocrats have outperformed the broader market by 1.7% a year over the last 30 years. Number 2, the rising stream of dividends can provide income in retirement without having to sell in down years. Number 3, the dividends can be reinvested to buy more stock. This can be done automatically in a dividend reinvestment plan known as a DRIP. Number 4, automatic reinvestment of dividends means that you will buy more as the stock price dips and buy less as the price rises, improving your overall investment. This fact can actually bring you joy when stocks fall, an important psychological benefit. Number 5, a dividend growth rate that is above inflation provides income that rises faster than inflation. In this way, dividend stocks fight inflation. And number 6, a stable and growing dividend tends to smooth out stock price variations. What else should we look for in stocks in these crazy times? Stocks have taken off like, fighter jets since COVID hit. Part of that has been from rising earnings. However, a much bigger factor has been that stocks have simply become more expensive. As an example, the price earnings multiple, how much you pay for $1 of earnings, has doubled since COVID began. So a big fear is that something will scare the market and share prices will plunge. What could cause that? A war, a scary security breach, political unrest. Who knows? But we're not exactly buying on the cheap right now. So ideally, we should look for stocks that have a long history of rising dividends, are low risk of a dividend cut, are cheap relative to the market, are likely to fly smoothly in turbulent times, have a stable, deep-pocketed set of customers, and benefit from rapidly changing technology. That's a challenging set of criteria, and it begs the question, are there any stocks that can deliver on that mission? One example is Lockheed Martin, or LMT, a major global security and aerospace company. They have increased their dividend for 20 years in a row. Given their business model, they are literally and figuratively likely to fly smoothly in turbulent times. In fact, they may well benefit from the turbulence. And I like the idea that they employ 114,000 of the brightest people on the planet, all working hard to add value and increase the value of the company and its shares. They do this while I play some guitar, ride my bike, or binge Netflix. Bless them. Looking back, their performance has been stellar. From January 2011 to January 2021, the stock has risen from $83 to $336. Not bad. The dividends have also grown from 75 cents to $2.60. Those numbers sound impressive, but what do they mean? To illustrate, say you had invested $10,000 in Lockheed Martin in January of 2011. 10 years later, you would be sitting at $40,386. Nice four-bagger. But that isn't the whole story. Over that period, you would have also received a total of $8,129.05 in dividends. But the real fun would have happened if you would have reinvested all of your dividends. That would have left you with a total of $68,326.51, an average growth of more than 21% a year. Whoa. The right dividend stocks fight inflation with both a rising stock price and rising dividends. As an example, the stock alone has grown an average of almost 15% a year, while the dividends grew by more than 13% a year, both well ahead of inflation, which averaged about 2% over the period. And incredibly, LMT is cheap, with a price earnings multiple of just 15.26, or about a third of the price of the overall stock market, the S&P 500. Back to the checklist. So how does Lockheed look relative to our checklist? Number 1, has a long history of rising dividends. Yep, 20 years and counting. Number 2, low risk of a dividend cut. They pay out a low 40% of their earnings in dividends. Number 3, is cheap relative to the market. It's about a third the cost of the market. Number 4, is likely to fly smoothly in turbulent times. They wrote the book on it. Number 5, has a stable, deep-pocketed set of customers, the US government as well as other allies and civilian customers. And number 6, benefits from rapidly changing technology. Obsolete defense gear is a great reason to replace everything. This summary. There are always solid investments available. The key is to take the time, select quality companies with strong management and a history of rising earnings. Dividend growth companies can add some stability and income to a portfolio, as we have seen. Investors should always build a well-diversified portfolio that aligns with their risk profile. Lockheed Martin stock was outlined here for illustrative purposes as an example of a dividend growth stock. Plus, it gives me a cool blog feature image. There are plenty of other stocks to consider as good long-term investments. Defense company stocks can also be purchased as an exchange-traded fund or ETF, allowing exposure to other firms in the space, including Northrop Grumman and McDonnell Douglas. There are also ETFs that include only dividend aristocrats, such as the SPDR S&P Dividend ETF or Vanguard's Dividend Appreciation Fund. You just listened to the post titled, "Can Dividend Stocks Fight Inflation While Accelerating Portfolio Growth?" by Gordon Stein of cashflowcookbook.com. I found this article pretty interesting as I don't spend much time thinking about dividends. But my curiosity over this article led me down the rabbit hole of some pretty interesting debates on the interwebs. Basically, there are a number of things a company can do with their profits. They can pay them out as dividends. They can use them to build the company. They can buy back their own shares, or they can buy other companies. When a company chooses to use their profit to pay dividends, it's great for the shareholders in the short term, but there is an opportunity cost there because that's money that's gone forever, and that's money they could have used to grow the company. So depending on how you look at it, choosing to focus on dividend stocks could be seen as trading growth for income. The other thing to consider is that in a taxable brokerage account, you'll be paying taxes on those dividends every year, even if you reinvest them. The good news is, for those in the 15% or lower tax brackets, qualified dividends are taxed at 0%. But for those in the 25% and higher tax brackets, you'll be paying tax on it. And ordinary dividends are taxed at your regular marginal rate, same as any other income. So people already earning a high income might not find a focus on dividend investing as advantageous due to the tax implications. It seems to me that many buy and hold investors don't prefer a focus on investments that pay dividends because it's more beneficial to control income for tax purposes when drawing down on a portfolio. When you receive a dividend, you have no control over the size of the dividend or the timing of receiving it, and 100% of the money you receive will be considered income. Whereas when you sell shares, only the difference in cost from your purchase price may be subject to taxes. And you can better control when you receive that income when selling shares to ensure it's not bumping you up into a higher tax bracket. I'm seeing a lot of pros and cons to an investment strategy that focuses on dividends, and it's all highly dependent on your circumstances and preferences. That should do it for today. Have a happy rest of your day, and I'll see you on the Friday show tomorrow, where your optimal life awaits.